I have spoken to over 150 ICT traders over the last 2 years, and there's three problems that hold these traders back the most. The first one is choosing the right fair value gap to actually trade from. The second problem is how to piece it all together. And the third problem is actually understanding that market structure shifts and fair value gaps don't work unless you have proper context. So in this video, I'm going to be breaking down how to get past this hurdle of choosing the right fair value gap and piecing everything together like a proper trading plan. The way that I typically trade ES futures, right? So what we can see here right off the bat is we can see structural highs and structural lows, right? So this is a structural high. Right, this is a structural low, then ES prints a new high. This is the all-time high at the time. This is a structural high. This is our structural low. And now recently, just before FOMC, we printed a new all-time high for ES. So this is obviously going to be 70.42 area. Now, the reason I like to zoom out, right, is because I think market structure is very important. And I think in 2025, 2026, it's one of the most misunderstood concepts, right? This is how powerful market structure is. Because if you know where your market structure highs and lows are, so for example here, what's happened is the previous high has been broken. So this is our new high. The reason this is significant is because I use a 4-step framework or a 4-pillar framework that goes through the markets like a book, right? So a daily bias shouldn't be difficult for you to position yourself in the market. It shouldn't be difficult if you follow these 4 steps. Now, the first step is obviously market structure. Now, when we zoom into more recent price action, right, we want to start understanding a couple of things. We want to start understanding, are we in premium? Are we in discount? Right? That's the next thing. So are we in premium or are we in discount? So what's happened now is we've had this correction down here. So this is our correction on ES. Now, because that's a correction, this now becomes a premium, right? By definition, we're above the 50%, we're in a premium area. Now, once you have that in place, those are the only ICT concepts that I actually use, right? So I use premium and discount. Yes, I use the basic market structure, but the one ICT concept that I use, and I think it's the most powerful ICT concept, is a 15-minute fair value gap. And so I'm going to be breaking down in this video how powerful a 15-minute fair value gap actually is, right? So this is how I use them. So before we go and look at a live example, I'm going to break it down in theories, right? Because I think understanding the theory is quite important. This here, sorry, let me just do that again. So this here is a 15-minute fair value gap right here. Imagine this is a fair value gap, right? So I don't actually trade. I don't trade the fair value gap. So what I look for is an impulsive move to the upside, right? So I use this impulsive move and my fair value gap is going to be somewhere in this region, right? So in blue, I'm going to look for an imbalance. And this is my key level, right? So my key level is derived from a fair value gap. So I just choose the last candle before the fair value gap. So a real case study of this on ES futures, for example, is a trade I took on the 13th of January, right? So let's quickly break this down. So on the 13th of January, I took a short, right? So I shorted from around 70.04 down to about 69.90. Right, this sort of area. So what made this a key level for me? Well, from a ICT perspective, right, we had this fair value gap here. Price left a fair value gap, and so I use the candle before the fair value gap. That is my key level, and that is the most accurate way to choose fair value gaps. Now, if we look at it from an ICT perspective again, what's happened is we've had a sweep of the previous day high, right? We can see here this huge wick has swept the previous day high. So this now becomes a sweep of liquidity. Right, so I do use some of the basic ICT concepts, but what I'm trying to say is I don't rely on them to make my actual analysis, right? I don't rely on fair value gaps for entries. I don't rely on SMT. I don't rely on power of 3. I use these concepts just as a guide, but the only ICT concept you need is a fair value gap. And so I'll break it down because I had a question recently, which is there's so many fair value gaps everywhere. So if I were to zoom out of this chart, right? If I just zoomed out, right? Or even if I zoomed into kind of more recent price action, so this pre and post FOMC price action, you could argue with me that there's loads of fair value gaps everywhere. There's some here, there's one there, there's one here, there's one there, there's one up here as well. So the question is, why do I only have primarily these 2 key levels, right? Ignoring the last one. Why do I only have these 2 key levels? Well, the reason why is because a key level isn't just a fair value gap, right? It's not just a fair value gap. So if we go back to our schematic over here, right? What's going on is price has left a fair value gap here. This is the FVG and this is the key level. I'm just going to write KL. This is the key level. So what you're looking to do is you want to see price coming back into this area, and you want to see price, basically the reason I choose the candle before the fair value gap is because when price taps into the level, it's entirely filled this fair value. It's filled the fair value gap. That is the reason I have my key level the way that I do. Now, what makes a key level valid is what goes on inside of this region here, right? That is what makes the key level valid, and it's your job to read essentially the price action. So when we go to our ES futures chart over here, so I had this level. So if you're an ES futures trader, you should have this level on your charts. So it's 70.04 to about 70.08, 09 area. So why was this a key level in the market? That is what I'm going to break down. And it actually came from the 13th of January. It came from the 13th. So on Discord, I took that trade on the 13th, and I'm just going to be breaking it down. So here's my Discord that I trade in regularly. So again, what was going on here is this was the short from that level, and this was the price action, right? This was the short that I took. So I shorted at 70.03, stops just above 70.012, targeting the next key level. Now, we want to focus primarily on what was going on inside the level. We want to focus on this price action, right? So again, this price action here is very telling. This is very telling price action right here. Now, when we have this 15-minute fair value gap, right, we understand it's held to the downside, basically. So prices come in and it's held to the downside. Same with here, prices come in, it's held to the downside. So this is our key level in the markets. This is our key level. Now, how do I know this is a key level? It's not because it's a fair value gap. That's only step one. Step two is we've actually validated it via the order flow. So if we just take a look at this this whole chart carefully, what we can see here up top is we can see blue delta. So I've made several videos on order flow, but what you want to do is you want to combine ICT concepts with order flow, right? That's what you want to do. So if I go back to my schematic over here, I'm going to keep coming back to this schematic throughout the video, so be prepared for that. So if you have any kind of ICT block over here, order block, breaker block, even supply and demand, any of these things, you want to essentially wait for the market to tap into your area. Now, in this case, I went short. So this was a bearish key level. Now, what made this a bearish key level was this. We had a break and we had a retest, and then we continued lower. So what's really going on here is you want to focus on what's going on in this region, and you want to focus on what's going on in this region. Because if there's one thing you take away from this video is I want you to understand a key level is where you want to trade from, right? A key level is the only thing that matters. And I want you to look at key levels like bus stops. So if you look at the market, right, you're only going to get certain opportunities at certain levels. Here, you know, even this was kind of the FOMC chart, but even here, you're only going to, you can see the market's pausing at these areas, right? Pausing at these levels, acting as supply and then flipping, acting as demand, right? So the best setups or the cleanest rejections, because that's all we're trying to trade, right? I had a question recently, how do you find a reversal from a continuation? That was a question I had recently. And the truth is, right, you could argue there's reversals and continuations everywhere, but what makes a reversal or continuation valid, in my opinion, is actually knowing where to trade from. So that's your key level. So if you're an ES trader, you need to have these levels on your chart. So again, this is 70.04 to 70.09, and this is going to be 69.90 to 69.84. So you need to have these two levels on your chart. So I'm going to break down why you needed these levels, basically. So if you're an ICT trader and you're trading fair value gaps, you're trading incorrectly because you're not understanding the core principle of what moves the market, right? What moves the market is limit orders, right? It's the limit orders that move the market. So let's take a look at this key level. What's going on here is we have our first rejection. We see a lot of heavy positive delta. So for those who've not watched my order flow videos, I recommend checking out the order flow videos. But just a quick summary on this candle here. There's a left number and there's a right number. The left number is the bid, the right number is the ask, right? So the bid is the aggressive sellers and the ask is the aggressive buyers. So when you see a bid, when you see a blue, these blue shaded regions, right? What that represents from a price action perspective is that there are more aggressive buyers and sellers, right? That's all you need to know. So when we go back to our price action over here, what we can see is we see a lot of buying, right? We see a lot of this aggressive, I'm just going to write AGG. We see a lot of this aggressive buying, right? We see aggressive buying, but we see a lack of follow through. Instead, we see the opposite, right? So think of it this way. If you saw aggressive buyers in this region, right? Surely the market would want to move up, right? Surely we'd want to break above, you know, the all-time high or whatever the high at the time. Surely we'd want to break above here or at least break above this level. But the opposite starts to happen, right? So the opposite starts to happen in real time. And so this is what confirms the level, right? Very simply, there's a couple of things I look for on the footprint charts. The first is I look for negative delta, heavy, aggressive negative delta. The second thing I look for is these finished auctions. You want to see a zero up top. So you want to see a zero over here, a zero over here, a zero over here. So what's really going on is this entire level is rejecting aggressive buyers, right? So these aggressive buyers are unsuccessful. So when we go back to, again, if we go back to our schematic over here, what's going on here is that there's been basically a failure of buyers in this region. Here, buyers have failed, which means that this key level is an area of supply, right? It's a supply zone. So I'm just going to write supply. It is a supply zone. The reason the key level is a supply zone is because we can see that sellers were in control, right? Sellers were in control. Passive sellers were in control, right? So again, I've made videos about what makes a passive seller. Essentially, what's going on is when you see these buy orders, right? The buy orders are being absorbed by the passive sellers. And that is the entire theory behind fair value gaps. That is why a fair value gap holds. That is why a fair value gap is valid. It's nothing more than that. So it's not a market structure shift or an SMT divergence or a PO3 or a CISD or any of these things. It is simply a fair value gap with passive sellers being present. That is the only thing that matters. Nothing else matters. Now, this is the thing that's interesting, right? I want you to visualize trading like a street with lots of bus stops, right? So imagine across, well, one, you need to know what street you're on, but you need to know where the trades are going to come. And the trades are only going to come at those valid key levels, right? So if you're entering the markets and you're just looking for a trade, or you're looking to follow the trend, or you're looking for a sweep or a break or any of these things, that's where ICT, in my opinion, fails most traders, right? ICT fails most traders because there's no context behind the move. You're not reading the clues of the market. Right, so what I mean by that specifically is there were aggressive buyers over here, right? There was actually a lot of selling over here. This was a very valid key level from the 13th of November, sorry, 13th of January. So what's going on here is if this is our key level, right? Here's our key level from the 13th, right? We can see multiple holds here. We can see multiple holds here. So we are seeing the supply zone hold in real time. Now, this is super important, right? This is very important. So when you have a key level, the market has left that clue. So don't ignore that key level the following day. So what I like to do is I will always drag the level to the right. So if I have a key level here from whatever day, Tuesday the 13th, that will then drag until 15th of January, and then it will drag until Friday the 16th, and then I will use it 2 weeks later. And what you will find is that you will get the best trades from these key levels, right? And the reason why, if there's one thing you want to keep in your mind, is that the market leaves clues on what it's done in the past, right? The market has left clues here, here, and here. And the only way you can see that is with the footprint charts. So if I bring up the order flow footprint charts over here, let's see how far it lets me go back. So again, what we can see here, again, if we go to the 16th of Jan, right? If we go to the 16th of Jan, what we can see here inside the actual level, right? Inside the level, we can see heavy aggressive buyers, aggressive buyers, aggressive buyers, right? So inside that level, we're seeing the rejection of aggressive buyers, right? Aggressive buyers are not being rewarded. And so the lesson here, the main lesson to take away is that once you have your key levels established, just drag them to the right and you will find the trades that play out will be at this level, right? These are the best trades that play out in my opinion. So just a quick example of that, right? We had Friday. So Friday price held as supply, right? This was supply. Now, if we Friday the 16th, so if we go now to, this was Tuesday the 27th. So this was the 16th. And this was the 27th. So this is, whatever that is, 11 days apart, right? This is 11 days apart. Now, what I want you to understand is that the market will remember these levels. The market will come back to these levels. And it's your job to know that. And it's your job to take advantage of that. And so how are you going to read this fair value gap here, for example? So it's very simple, right? Let's go back to our schematic over here. It's a very simple concept. Now, if I just clear some of this away, we've established previously that this was a supply zone, right? From the 13th of January, we created a supply zone. Now, when you create a supply zone, what that basically means is sellers were in control. That's what it means. It means sellers were in control. Now, let's take a look at this same thing again. So what we can see here again is sellers took control of the market here. Here's where sellers were in control. Now, what's interesting here is when we come back to this level, let's say we come back here. So we've come in and we've tapped in and we've broken through, right? This is how basic the logic is. The logic is very basic because if we break through, what's really going on is that the previous sellers over here, those same passive sellers, weren't showing up here. That's why we broke above the level. Now, your job is, the money is always in the retest. I've made videos about this. The money lies in the retest. So you need to trade, or you need to understand this region, right, before you take any kind of breaks. Now, I'm going to be going over an example of how you can do this, right? So again, we're looking at ES. So if we go to ES futures 15-minute time frame, or let's jump to a 5-minute time frame. So on a 5-minute time frame, this is a trade I didn't take because I don't trade this late, 9:30 in the UK. But breaking this trade down is quite something. So we're going to start all the way from the beginning. So we had this surge to the upside over here. We had this surge, and so what we're looking for is a break above the level. To go long, we want to see a break above the level, right? Because those previous passive sellers are no longer holding. Now, this is very apparent. So if this is our key level like this, we have a key level that looks something like this. So if this is our key level, what you're looking for is, we had sellers holding previously, right? Now we've come into this area, we break, we're looking for the opposite. We're looking for buyers to step in. Now, this is where the ICT community goes wrong. They don't understand what's going on here. They don't understand what's going on here. And the mistake they make is that they don't read the clues that the market has already left, right? The market leaves clues on what it wants to do. So your job is to, number one, read where those clues were left and enter where those clues were left, right? It's not, I know it sounds simple, but it's true. So when you have a supply zone like this, when price comes back to that zone, it can either be a supply zone or it can be a demand zone. And you have to read that. Now, the main message is that the best trades you're going to take are going to come from this level. It's not going to come from anywhere else. The best trades you're going to take are all going to come from this level. So you're looking for essentially the pattern, right? You're looking for this. So again, there's two things. There's pattern recognition and there's pattern utilization. So first you have to recognize the pattern, and then you need to be able to use the pattern in real time. So this is the pattern that you're going to have to recognize. But once you recognize the pattern, you can start to use the pattern to your advantage. And this is where we're going to be going over how you could have essentially used this to your advantage, right? So here we have our classic break and retest model, right? So this is your classic break and retest. So this is where I again disagree with the ICT traders, right? A lot of ICT traders, what they'll do is they'll do something like this. They will take a structure break, right? So they'll take a break of structure, and they will look to enter off. Either they'll look to go long here, for example, or wherever, and they'll have their stops below here, or they'll do something, right? The ICT crew, you know, they'll do something, right? They'll do something. So if you've ever taken losses like this, typically what's going on is you just don't know where the absorption is happening, right? So you need to time your trades with the correct level. So this here would not be a good example of a trade. You're not interested in things like market structure shifts, right? So this here is wrong. You're not even interested in lower time frame fair value gaps. A lot of people would point to this zone over here and say, oh, you know, it's a fair value gap, whatever. You're not interested in that, because on the 1 minute time frame, a fair value gap doesn't mean anything, right? You want to start on the 15-minute time frame, and you want to understand where the absorptions were actually occurring, right? This is the most important thing. Now, with that being said, how do I like to trade this, right? What's my kind of criteria for this? So once I see a break like this, I'm looking for a retest. And so the retest is going to occur in the key level. This is your retest. And so I'm happy to enter just as we break above, right? So I'm happy to enter here, for example. I'm happy to go long here. I'm happy to have my stop below the zone, right? And I'm happy to target the next local high, which is all the way up here, right? This high here. Or maybe beyond if you really wanted to, because we are in a bullish market. Now the question is, how do you break this down, right? How do you break this down? So again, let's bring NQ into this as well. So NQ looks something like this, right? So ES and NQ, they move very similar. So anything I say on ES, you can apply it to NQ. But truthfully, if we look at this zone over here, right, on the ATAS, on the footprint charts, right? So on the footprint charts, they look something like this. If I bring this up, footprint charts, here, there we go. So on the 5-minute chart, let's break this down. So what we're seeing is this huge kind of move to the upside, So the reason this move was successful wasn't because of ICT or sweeps or breakers or VWAPs. It's none of those things. None of these things matter, right? So here's a list of things you don't need. Just writing it down. There is a list of things you don't need. So this is what you don't need. You don't need a market structure shift, right? You don't need that, because typically when you wait for a market structure shift, you've already missed the move, right? You don't need a market structure shift. You don't need a 1 minute fair value gap. You don't need a 1 minute I fair value gap. You don't need an SMT divergence. And truthfully, you don't even need to follow the trend, right? Although that does help sometimes. You don't even need to follow the trend. You don't need to do any of these things. You don't need VWAP. That's another one I've heard. You don't need VWAP. You don't need any of those things, right? Put these things to one side. Here is what you need, right? Here's what you need. You need a key level, right? This is your bus stop, right? I know it's an analogy, but you know, this is your bus stop. So if you don't know which bus stop to get onto, then you're never going to get to your journey, right? You need to have the right bus stop. So the key level acts as the bus stop. Now, when you get in the bus stop, right, this is where the analogy breaks down, but I like to think of it as like a story. So first you have the beginning of your story, which is a key level. The next thing is you need to be able to read the main characters, right? Actually, take a train, for example. Take a train. Let's say if your key level is a train station, right? Now, if your key level is a train station, when you go into a train station or any of the major ones, there are so many different stops you can take. There's maybe 14 different platforms or 14 different stops. And so how do you know which stop is yours? How do you know which sign to read? How do you know which direction to go, right? So what are the main characters of that train station? So in other words, what are you looking to read, right? What are you looking for inside of here, right? What are you looking for? Well, you're looking for buyers versus sellers. So this is the things that you need, right? So this is what you need, buyers and sellers. You don't need all of this list over here, right? So for the ICT traders, you don't really need that, so I'll get rid of it. What you need is one fair value gap, which is like your train station. You then need to know what to look for in the stations. You need to know whether your buyers are in control, whether your sellers are in control. Now, the way we do that again is by looking at this chart over here. Now, specifically, if we break this one down, this is what we're going to be breaking down. So these are buy orders and these are sell orders, right? It's that simple. So let's break down a candle, right? Let's break down this candle here, this doji. So this doji is interesting because this doji, we only need to read one candle to understand what's going on. So if we look at this candle here, what we can see, a left number and a right number. Now, typically what I'm looking out for is zeros, right? I like to see zeros, 12 for 0, 31 for 0, 10 for 0. I want to see the zeros on the ask side. So what's really going on is we have a lot of aggressive selling inside of the zone. So as we tap into the zone, I'm not looking to read every number. I'm just looking to read the story inside of that key level. What is the story? And the story can be who is aggressive. So in other words, who is being aggressive inside of that level, right? Is what's going on inside the fair value gap, right? Who is being respected in the fair value gap? So in this case, we tap into this fair value gap over here, just this one here. We tap into this fair value gap, and there are a lot of aggressive sellers, right? Just over here. Sellers, right? Huge amount of sellers, right? Sellers, again, sellers, again over here, sellers. So we have a lot of negative delta, aggressive delta, which indicates that sellers are really being aggressive. Now, my question to you is very simple. In this entire region, right? In this entire region, sellers were being aggressive. Now, the question is, were the sellers successful, right? Well, the answer is no. The answer is no, because if these sellers were successful, they would have been rewarded with down through or with follow through, as they say, right? Were these sellers successful? So let's get these two charts up next to each other, right? So for all the ICT heads, there isn't a single pattern or a concept or a YouTube video that can explain what's going on other than the footprint charts, right? So the footprint charts give you an indication as to what's going on. So here we are, right? Let's get them up side by side. Now, when we get them up side by side, what we can see here in the yellow box translated to the right, we see heavy selling aggression. So the reason the footprint charts are so advantageous, in my opinion, is because footprint charts show you in real time who is being aggressive. So are there more buy orders? Are there more sell orders in real time inside of every fair value gap? And so coming back to fair value gaps, if you struggle with fair value gaps, it's because you don't have any context behind them. And when you don't have context behind fair value gaps, that is a big problem. Not having context behind a fair value gap just simply means you're going into a train station and you don't know what platform to go on. You're going to get lost. That's the way that I see it. So again, we have the actual trade, which ended up playing out. I didn't take this trade, but it ended up playing out quite well. Again, it's important for traders to understand what's going on right in this region. So ES, just breaking it down again, if we go to a 15-minute chart, for example, right? Again, what made this long valid, right? So we've kind of been through an entire story arc in this video so far. So what we've done is, remember we started off on the 13th, right? We started off on the 13th. So again, quick summary of what we've been through. When I started on the 13th, I saw the following. I saw a sweep, I saw a fair value gap, and then I saw an absorption in this area. This ticks the fact that it's a key level, right? This confirms that it's a key level. This means it's actually a key level, because if we break this down, right, what was going on here, for example, right? What was going on here is reflected here, right? All the buyers were trapped, which means that this is a sell zone. It's aggressive sellers that are failing. Sorry, it's aggressive buyers that are failing, which means sellers are really in control in this zone. Now, we just want to extend this logic over, because this is the question I get the most. How do you choose your key levels, right? This is the number one question I get the most. How do you choose your key levels, right? What key levels do you use? How do you use them? How do you derive them? So I'm trying to make it super clear that this is how I derive my key levels, right? So key levels are a function of seeing where the market's reacted, keep back testing them throughout the weeks, and then ultimately your best trades will still come from these levels, right? That is the way that I like to do them. That's the way I like to find my key levels, right? So if you're an ICT trader, just bear that in mind. Just bear that in mind, right? So that's everything from the that's everything from the key level side. So I wanted to finish off this video also going through some lower time frame stuff as well, right? So if we go to the 5 minute over here, let's break this down. So I know a lot of traders, they trade breakouts, right? They trade breakouts. Now, breakouts are great, but breakouts don't work unless you have a key level in place. So if you were trading a 15 minute, let's say you're trading a 15-minute breakout. So this is how most traders trade it. They take any random breakout. What you need is a key level. This is the most important thing. I know I've spoken a lot about key levels, but you need to be able to hone in where your key level actually is. Once you have your key level, you then want to focus on your 15-minute or your 15-minute opening range breakout. And the only reason you take a breakout is because you have an order flow confirmation. You need to know who is aggressive and who is trapped in this entire region, right? So yes, we had a key level down here. So this key level again was derived in a similar way. All right, so I had this key level from quite a while ago, I think. I had this, yeah, so a similar sort of case over here where this key level was derived. Again, it was a fair value gap, heavy amounts of selling. This is also a supply zone. So again, hopefully you're understanding the lesson of dragging the zone to the right. Just keep dragging it, because you will see this will unlock something in your trading if you do it right. Just keep dragging the level to the right and you will see how accurate the market holds these levels, right? The market stalls at these levels here. The market will, stall and react here. So again, continuations and reversals are easy to spot if you know where the key level is. Now, from a lower time frame perspective, right? So let's just break this down. So you first want to understand breaks of structure. You first want to understand breakouts. So if you're using a 15-minute opening range breakout, let's say you're using a 15-minute opening range breakout. So you're using the first 15 minutes. So that's going to be, where are we? There we go. So here's the first 15 minutes, right? So we have a breakout here, for example. Let's say this is your 15 minutes. So this is your 9:30, this is your 9:45. So here we have the 15-minute high, something like this. And here we have the 15-minute low, something like this. Okay. So the question now becomes, what makes this opening range breakout valid, right? How can you confirm this entry on the lower time frames? Now you have a high, which obviously you can see we've broken it, and we have a low down here. So the way that I would validate this is simply by understanding the price action at the low, because we've tapped into a key level, right? Understand the price action at the low, and that's what we're going to do. So again, we had this rejection over here. So this rejection here, right? You can see this 15-minute rejection here. This was a 15-minute rejection. Here's our 15-minute rejection. Here's our 15-minute rejection, or our 5-minute rejection. Now, again, what's going on here? Was this a confirmed key level? Absolutely it was, right? So what we can see here is we have this huge kind of red candle here. This one here. So let's get them up side by side. So we can see this huge negative kind of red candle, right? Massive red candle down here. A ton of selling, even this green candle here, bullish candle. But when we dissect the bullish candle, this is why order flow is so interesting, or I find it interesting, right? What you're looking for is, it's a green candle, but we see a lot of aggressive sellers over here, a lot of aggressive sellers at the opening, and we bounce off that key level. And so this here is what creates the 15-minute range. So we have our 15-minute high, our 15-minute low. So the 15-minute low is, we see essentially buyers propping in here. These are buyers, right? Passive buyers. These are buy limit orders, passive buyers, right? We know that buyers are sitting here because of the heavy aggressive selling absorption here. Now, the second thing is when we break above our key level, because breaking above a key level is very important. So we break above a key level here. You want to know what's going on in this region as well. So this rejection, right? This rejection. So what we're seeing basically is sellers being absorbed. So we see that over here. This is the absorption because sellers were aggressive, but sellers were unable to really break below the level. Now, the same sort of thing happens here, right? So we see this clean rejection. We see, again, we see 231 for 13, right? The 0 has been printed. This is the 0, low of the session, open of the session, right? 9:35 Eastern, right? That's that 5-minute candle. 0, 0, right? 0 prints all the way. Same thing over here. We have this rejection to the downside. So this is within that 15-minute range. So if you're trading the 15-minute opening range breakout, the same thing happens here, right? The same sort of thing happens here, right? This is your rejection. These are your rejections. So we have a rejection of the open, then we have our rejection in the 15-minute range. Now, inside the 15-minute range, we have this candle. We have these aggressive sellers, but the market breaks above the zone. So what we're seeing essentially is heavy amounts of aggressive selling, but no reward, which means that buyers are in control, right? There are buyers stepping in here. There are buyers stepping in here. There are passive buyers stepping in here to absorb all this aggressive selling, right? That is what's going on from a footprint chart perspective. So ICT concepts are great, right? And I started with ICT. I wasted 2 years of my life on ICT. I didn't really make any money with ICT. And the reason for that is because I found the concepts everywhere, right? I thought that the concepts were everywhere, and I thought that I could catch a trade every day, and I found that some trades weren't working out. Sometimes I would use an ICT model and it wouldn't work, and I just didn't understand what was going on. So hopefully in this video, I've cleared up how to find key levels, what goes on inside key levels, and how you can combine your ICT concepts with order flow to get better results.